I appreciate that we've got just about everybody with us at the moment, and a few more connecting even now. Morning, Griffin and Mason, and I was on Zoom a little bit ago with both Alex and Logan, and so I think we're pretty well prepared for today's discussion with respect to the Black-Scholes option pricing model. I want to make sure that we do a couple of things today. And we're gonna lead with the discussion on that model. Good morning, John. We're gonna lead with the discussion about that model, but I want to make sure that we spend a little bit of time talking about why I pushed back the case valuation assignment to next week. Although some of you I think have already completed it. And I want to look at talk a little bit about the assignment that you'll have for motivating the Black-Scholes model. I want to look at a subject company by the name of Mira Drovanna, which I don't believe I've shared the Mira Drovanna case with you guys before. But I'm going to discuss Mira Drovanna just a little bit, and then we're going to talk about how you might apply an issue with multiples to that model, how you might apply an issue with respect to Black-Scholes to that model, and how you might apply mark-to-market accounting concepts to that model and how it would affect the valuation outcomes and what we would see. So we've got a couple of things we're going to do. Any questions that you guys have with respect to either other projects you're working on, things you're dealing with that fall outside of the areas that I just referenced?
No.
Who has the Monte Carlo pricing simulation?
That would be Patrick and I.
Gird up your loins. Okay, so some of the work that they've done, especially in talking about volatility and putting together that volatility sheet, may well help you guys. I believe that we're due to present that in 2 weeks, right?
I think so, yeah.
Yeah, because I believe, do I recall correctly that next week that we are with another one of the valuation firms? Or am I getting my schedule?
I want to say off the top of my head it's Scalar, but that could be wrong.
That's what I think as well. I'm going now to look at the syllabus. I think that they're next week, and that 2 weeks from now we have Monte Carlo. Well, let's just confirm that for a moment. No, in fact, I'm almost right. So so next week, our concept development is on the valuation report itself. Which of you has the valuation report responsibility?
I don't think that's anyone here, to be honest, because from what I remember, everyone else has already presented.
Yeah, so I'll look at that, but somebody's got it. Maybe it was me, but I don't think so. I'll find out. So next week we have the valuation report, then we have Scalar, and then we have Monte Carlo. So John and Griffin, you guys have, you've got, excuse me, John and who was the other?
Patrick.
Patrick. So John and Patrick have 3 weeks. I would start looking at that now because you're going to want to understand it well enough to break it down with the kind of simplicity for us that Logan and Alex have broken down Black-Scholes. And you can do that, and I'm happy to help do it, okay? But that's a few weeks out. Okay. Any other questions to respect to the concept development assignments or what we've looked at today?
Rick, I know you wanted us to talk about the Black-Scholes assignment after that presentation. I don't know if you're going to touch on that. I was just bringing that back up.
Thank you, Logan. In fact, I'm going to talk about a couple of things with respect to the assignments now.
Okay.
And at a point, I will go ahead and even share my screen out to another spreadsheet. So I extended the case valuation assignment until next week. And I did that for a couple of reasons. One was we hadn't really talked much about it at all. And I felt that it was fair, and we have the luxury of time here, in part because the final assignment in the job market development series, you'll recall I've canceled that because we're not getting together to do these big speed interviews. So I've canceled that. That would have been on April the 7th or 8th. I pushed the case valuation assignment being due out until the 7th. You're certainly welcome to submit it before that. A few of you already have. I want to make sure that in that assignment, though, that you recognize that this may be something more than simply using some of the material that you've already provided us in your midterm assessment. In the midterm assessment, you'll recall that you came up with values under various scenarios, but you didn't have to come up with and hang your hat on a valuation. Here, in the case valuation assignment, I'm expecting you to come up with and hang your hat on a valuation for the firm as the firm exists. So not under one of the various scenarios, but as the firm exists. So this is a present value. And you're going to show us how you came up with that. So within this, I'm expecting you to not only deliver to me a spreadsheet or copy elements from a spreadsheet into a Word doc, but to show me how you came up with a valuation. But I'm expecting you're probably going to use more than one model, and you're going to then help me understand with the different values that are detailed from the different models, you came up with value X, and why you're going ahead and putting your professional credibility on the line, saying the value is X, which means that you're going to have to do more than just give me a spreadsheet on this. You might remember that in the first couple of these assignments, I came back to you with some general comments, and I shared for everyone. And general comments that was shared amongst those first two was that simply giving me spreadsheets, while I might be able to find some of the technical answers within them, isn't what I'm really looking for here. I'm looking for a combination of you having done the quantitative work and then packaging the outcomes of that quantitative work into a narrative so I can understand the outcomes of the quantitative work. And I'm expecting you to do that with this as well. Excuse me. So as you go ahead and give me the case valuation assignment, I'm expecting that assignment to not only show me the numbers and how you got the numbers, the inputs you used, but a narrative to help me understand how you got there and what that number means to me and why you're hanging your hat on it. I'm not giving you a certain number of words for this, but recognize that all of this is leading to some of the final work that we do, right? So all of these elements kind of builds up into the final work that we do. So that's why I pushed that back, and I wanted you to have an opportunity to spend some time on that if you hadn't already done some of that. And we have the luxury of time because we have an assignment that we've taken out, okay? So let's talk about how I expect you to utilize the Black-Scholes. Very similar to what I just said with respect to case valuation. So I expect you to use the model forms that have been given you, and you might even at the point want to send a nice thank you note to these guys, because I think they've delivered to you some models that are very useful here, and they walked you through them so you can know what the changes are and how things work, and you can put this in. The only real work you're going to have to do is you're going to pick up that volatility sheet and you're going to put your different prices in, and you're going to get those prices because I gave them to you within the case. Remember when I expanded these cases, I gave you a series of values for prior year prices for the equity. Well, I did it because I was going to need that, or we were going to need that when it came to Black-Scholes and when it came to Monte Carlo. So go ahead and input those values, get the outcomes, and then couch all of this in a narrative, helping us understand you've prepared this analysis, here's the outcome of the analysis, here's the inputs, and here's what it means and how we are likely going to think about using it within the case that you already have, whether it's DDD or Tech Hub or Warrior or whomever it is. So again, a narrative and a quantitative analysis packaged together. Any questions about that?
Not particularly that, Rick, but going back to the valuation, when we're doing the valuation, even with the multiple different scenarios ran, those scenarios would still need to be inside of our 10% range of value, correct?
Well, I think they should be, Logan, because if they're not, it suggests to us one of two things. Either we've selected a model form that shouldn't be used for this company, or we've misinterpreted an input that is giving us spurious outcomes. So let's talk about that model selection. We've dealt with free cash flow, KVD, APV, economic profit, forward market multiple, or just using a multiple as a broad brushstroke. We've dealt with blue sky. We've dealt with then, what other model form have we spent time on? I think that kind of runs the gamut. Would we use all of those model forms in a panel of models to come up with a price or a value? Well, I don't think we would. I think we might use 2 or 3 of them, the 2 or 3 that we think might apply to the firm. I don't think we would use all of them. For example, I would never put a model before you for a firm using a revenue multiple when the firm is very mature and has had a consistent stream of positive EBIT and EBITDAs. Nor would I put before you an EBITDA multiple model when I'm looking at a firm that's never seen a positive EBIT. So I'm going to think about this. I wouldn't use an APV model form on a firm that has no debt. Why would we bother? The only virtue of the APV form is to deal with that secondary cash flow, which is the tax shield, which is a result of interest coming from debt. I wouldn't think about expressly a free cash flow model if I don't have free cash flow, if all I have is solid discretionary earnings. So you're going to have to think about what models you might want to use here. And you got full freedom to do this. Just make sure that they're relevant, okay? Okay, so let's assume for a minute that we didn't have price data on a company. You're now sitting in Pineta Manufacturing. You've been retained as these professional evaluation consultants. He's paying you $25,000 to do a valuation analysis on the firm. And he's doing this because he wants to go ahead and issue some stock options to his trusted employees. By the way, that would be John and Griffin and myself. Okay? So we don't have public trading on this. It's a private company. He's never had a valuation done before. But he wants to have us motivate the Black-Scholes model so that he can consider giving stock options to these 3 trusted employees. How's he going to do it?
So, I mean, first, obviously, we have to get the value of what the firm is today, but then would you be taking the historical volatility of that industry?
Okay, that's interesting. So I might think about the industry's volatility. Okay. How else might I think about giving myself a volatility measure if I don't have stock price information from prior periods?
You could theoretically use the equity value, like Logan had spoken on earlier, equity value per share, and use the historical information to find the historic equity value per share and then base volatility on that.
Exactly. So think about this. So Gerson has been tasked to do this, comes back and says, well, I don't have the information because these valuations weren't assessed over all these time frames, or I can't see market transactions over these time frames. So how do I come up with a price? Well, why don't we just go ahead and say, all right, I'm going to pretend that today is 2005. And I'm going to look at the data available to me from the balance sheet, income statement, and such in 2005. I could come up with a risk-free rate for 2005 pretty easily. I could identify what the 2-year treasury or the 10-year treasury is, or the 6-month T-bill is in 2005. I can do all of that. And coming up then with that valuation, I can work it into an equity value given the information from the income statement and the balance sheet, and I can come up with a theoretical stock price for that period of time. Now, if you're going to do that, what we can't do is assume that the way the markets have acted since that moment in time would have been known to us. We have to use expectations from that moment in time, just like we use expectations that we know about today to think about stock values for tomorrow. That gets a little harder. And I'm not suggesting to you that you necessarily need to do this. I want you to understand how you would do this if you needed to. You can go back in history and say, if I look at the economic conditions, including the conditions for this industry, during that period of time, then what assumptions would those have led to? And then I can take those assumptions, the model forms we know, and the inputs that you would have from the income statement balance sheet for that period, and you can reconstruct what the equity price would have been. And once you've reconstructed that, then you can run those values for those different years into the volatility worksheet, and you now have a volatility measure. Okay. However, the bias that is going to exist is going to be towards reflecting what we know has happened between that date and time and now. So when you're thinking about what would the assumptions have been at the time, recognize we will be biased towards and interpret those more along the lines of what we actually know has happened. And that's the hardest part of this, is making sure that your assumptions are correct. Some of you know Jeff Pickett. And Jeff is, well, I think we've all met Jeff, of course. Some of you know Jeff well. And Jeff talked to us at one point about having had to go back through and do a valuation based upon 1992 data, instead of having to reconstruct something for 18 years in the past. And the hardest thing to do there was to avoid that bias and avoid inserting into this things that we've known since. You have to act as though the future hasn't happened yet and just think about what we would have known. That's challenging. Okay. Any other questions or comments that you might like to look at with respect to any of these items before I move to a spreadsheet for a couple of minutes? Okay, I want to point something out that you may have already identified. I'm going to share my screen. And first I'm going to bring up a PowerPoint that I'm using actually for my MBA course on this subject, in which we had to take this company, Mira Drovanna Enterprises, and we had to identify what their value was, so that we could then identify what the enterprise value was, and we could then move that back to identify what the different stock values are. So, and I'll share this with you in case some of this might be interesting. We've done this already together using through some of our discussions as we have looked at enterprise value and moving to equity value per share. So you've done some of this. But I want to use this information now in thinking about multiples. So here we broke this down so that we then realized that we had a common price per share for this subject company of $1.69, and we had a preferred price per share of 85 cents. Okay, so remember those, $1.69 and 85 cents. And I'm not going to walk back through how we got here. You already know how to do that. And if you don't remember how, then walk through this and walk through the other material that we shared with you with this. So $1.69 and 85 cents. Now, I want to move to Mira Drovanna. In the case of Mira Drovanna, we have 2018 and 2019 data. And in this case, we can observe that based upon the 2019 enterprise value, which is a function of the market value of the common, market value of the equity, and then the market value of the debt, of course, in cash. When we looked at the EBIT for that moment in time, and when we looked at the enterprise value, we identified a multiple that is reflective of the information here of 9.25, 9.28. But when we actually run a valuation for this company, I used a multiple of 4.25. I used that multiple largely because I know enough about the firm that I was able to go through and deal stats and pitch book and the various ways that we would find multiples, and I identified that a 4.25 multiple is a realistic multiple based upon market comparables. That being the case, if I identify elsewhere that 4.25 is a realistic multiple, but I'm looking at my own company's history and see that last year we actually we observe a 9.25 multiple, why would I use the 4.25 rather than the 9.25? What is the 9.25 saying to me that is different than what the 4.25 multiple is saying to me?
Is it the amount of growth that you had last year is greater than the current expected growth of the marketplace?
Well, it is, Logan. In fact, a 9.25 multiple would be suggestive or inferring a much higher expected growth rate than a 4.25 multiple, right? I think we would all agree with that. So here's what I thought was interesting. I wanted to show you. This is built on some stock prices. And in this case, the common is built on 4 and an 8.
We are located in the Utah County Health and Justice Building at 151 South.
So one of you might want to mute. Thank you for doing that. So it's built on a common share value of 4 and an 8 and a preferred share value of 2.5. Well, that's interesting. We just broke these down, suggesting that the common share value should be $1.69, and the preferred share value should be 85 cents. Look what happens to our observable multiple if these prices in the common and the preferred were more in line with what our valuation expectation is for them. We converge not directly on the 4.25, but much more closely to it than the 9.25. Now I want you to think back about what we know from Mr. Demoter and your very earliest exposure to him in those videos that you watched in the first week of Finance 309. And in those videos, he talked about two things. Well, he talked about many things, but amongst them, he talked about the difference between pricing and valuing. And he talked about one of the companies, I think it was Uber perhaps, that he was not interested in Uber, or maybe it was Apple. He wasn't interested in Apple because he thought it was overvalued. Well, how did he come up with that? He went through and identified the estimated value of the company. He broke that down then into the value per common share of stock. He then compared that to the then present price of a common share in Apple and found that his value estimate was significantly less than the price he observed in the marketplace. And in so doing, believed then the stock to be overvalued and indicated he wouldn't be an investor. Well, okay, we get that. But what I've just done with you is kind of giving you an example of how this would play out. And in this case, we see that this stock price, the common price, had a 4.25 or 4 1/8 price, but only $1.69 value. So I'm walking you through this to try to ingrain the difference between price and value and to recognize that a multiple tends to be, a pricing measure rather than a valuing measure. Because if we were going back to the actual price that we had seen for this company, both in its common and its preferred, we saw a price indicative of a 9.25 multiple. But we absolutely wouldn't use that multiple to create a value. Does that make sense? I want you to think through this a little bit. In fact, as we talk today, as we talk then next week and the following week, I'm going to be walking through a couple of little interesting elements or things that I think that are interesting. And I want you to remember that I only share things with you that I think might be useful to you. So as you think about some of the future assignments in front of you as we round out this course, remember that I've shared with you some things I thought were interesting, which might mean that you might want to think about how they would apply to your final assignments. Fair enough? Okay. Any other questions or comments with respect to today?
Rick, when you're saying the multiple is more of a pricing tool instead of a valuing tool, are you saying the implied multiple is more of a pricing tool or
Yeah.
the actual market multiple as well?
I'm saying that the utility of a multiple is more of a pricing mechanism than a valuing mechanism. If you look at Damodaran's work, and I keep going back to him just because he's a whole lot smarter than I am, and he's got a lot more experience in this, okay? But if you look at Damodaran's work and think about how he talks about price versus value, Damodaran virtually doesn't use a valuation multiple when he values a company. He uses a valuation multiple when he thinks about the price of a company. And he uses discounted cash flows and everything that goes with those in various model forms to talk about the value of a company. When we look at the three valuation constructs, so an asset-based valuation, a market-based valuation, and a discounted cash flow or income approach valuation, what we're looking at is the difference between price, so market-based, because markets set prices, and so price versus value. Analysis can inform us of what the value is to us based upon our discount rates, our utility, etc. But the price is something set by a variety of economic agents in a marketplace that have bartered back and forth and have negotiated on a price. The price and the value aren't necessarily the same thing. In fact, if I identify that somebody's got a value of 10 and its price is 12, I stay away from it because I believe it's overpriced. Okay? Good question, Britton. So Griffin, you look very intent. I mean, you're either all wrapped up into what we're saying or something very interesting is on your screen that you're reading. It's okay, brother. I just had to mess with you for half a second. Okay. Any other questions or comments with respect to today, guys?
So I've just got a quick one going on what you said of value and price. So in the case, let's say, not even at the firms we're looking at now, but you're doing this in the industry. Let's say you get, I would think, and I just want to verify, it's a good symbol if you get a price using a multiple that is very close to a value using a DCF.
Yeah, that would suggest that the stock is reasonably priced in the market today compared to the assessment that you've rigorously offered as a valuation consultant. That's exactly right.
Okay, that's all.
Yeah, no, good for you.
Thank you.
Rick, when you're doing evaluation for tax purposes, would there be any instances in which somebody would question why you use a multiple instead of another method?
Certainly. In fact, when you do evaluation, you're going to recognize that you'll provide, at the very least, a income-based approach and a valuation approach, which means an income-based approach and a multiples-based approach, which is synonymous with income and market approaches. In fact, if a company is not trading in the market, and if there's not been a series of valuations done before the one that you do, then the valuation industry requirements are such that you would also do an asset-based approach so that you could ferret out goodwill. Okay, if valuations have already been performed on a company and you have those, or if there's market values based upon market activity, then you don't need to provide an asset approach valuation. But you always do at least an income and a market approach. And it's the income approach gives you valuation, the market approach gives you price, but we're still going to look at both of them because we can't ignore that economic agents in a market are suggesting a price of X. We just can't ignore it. If that price is meaningfully different, the price that our valuation is suggesting, then we have to consider what that different means and how we would react to it or how we might use it as business people.
Have you ever been approached by a business owner and been asked to do a specific valuation with a specific model?
I don't think so. I don't believe that I have. And what I'm reflecting on for a moment is less about have I been approached that way, because I've not worked as a professional valuation consultant much at all. I don't put myself out there, although I do a couple of times a year end up being asked to do valuations. And when I tell people how much I charge, most of the time they say, no, thank you. But those few that have said, okay, I'll go ahead. If they're willing to impart of that amount of capital, I'll take the time. But what I was thinking about was more along the lines of when I had my private equity firm and when I was looking at valuations performed by analysts working with me and whether or not I would expect them to use a particular model. And I don't think so. I'd have them use a model based upon the scenario. I'd have them use a particular model based on the company and its life cycle, where it was in that life cycle. But I didn't come at this saying, I want this model applied to this company.
Thank you, Rick.
Certainly. Hey, well, I hope you guys have a good day. Hey, Mason, you and I need to have a conversation. I meant to call you last night. I'm terribly sorry that I didn't. It's my fault. I'm going to give you a call in just a couple of minutes if you don't mind, okay? Well, there. You're good with that, Mason?
Yep.
Thanks, brother. All right, guys, thanks so much, and I'll get this posted, and we'll talk to you later.
Thank you, Rick. Thank you.
Have a good day.
Thanks, Rick.